I just want to say a very good morning to all of you. Thank you for coming. Uh, what I want to do today is to just pick up from where we left off last week. I want to share with you a bit more about, not credit, um, the topic of interest rate modeling. And as you recall, so I'm going to go to the slide deck of last week first. And so we were on the topic of how you would try to model interest rate, and I showed you a couple of different approaches. These are what are sometimes called short rate models. Actually, first of all, just by way of admin, let me quickly show you something. Actually, for this week, I just added some notes on skews and kurtosis and the short rate process of working example. I'm going to show you. I wrote it out in longhand, so I'll show you that in a moment. But just by way of admin, I do want to tell you that so we have, so the end of the term or the end of the program is coming up. Now, some of you are asking me where you can find if you want to review the video records of previous tutorials. Actually, all of these that are in green and underlined, if you go into the tutorial file and click on these, it should take you directly to the YouTube coverage right away. Now, what I do want to say today, so we are here. We are today is the 25th of May, 2019. You will see Keith two more times. That is today, and then next Saturday. And so after today, we also will meet two more times next Saturday. And now, if we were to meet the Saturday after, that would be the 8th of June, 2019 for the tutorial. But as you know, your exam actually is on the 8th of June, 2019. So I think it's a bit silly to do that. So we're not going to. And I have actually moved, as best I can, I have moved our last tutorial forward a few days to the 4th of June, which will be a Tuesday. Now, I'm going to try and do that in the evening. So it will be just across the road in YIA 40. It's actually a smaller room, but it can take around 30 people. We've never had 30 people for the tutorials. So we're going to do that, and I'll try and wrap up the course for you. So that is the last tutorial. So that's by way of housekeeping, and I will send out individual invitations to your calendars. Is everyone okay with that? Yeah. Okay, that's good. And now I want to just pick up from where we left off last time, and talk a bit about interest rate modeling. So these are the slides for last time. And as you recall, so we talked about CMS, but that's more for your career and professional interests. We talked about how you would model short rates, and this is modeling it using what's called the equilibrium models. And then I showed you another approach, which is another class of models called no arbitrage models. And it might be good actually just to go back a bit and open the conversation by I'll come to that in a moment. Open conversation by simply reviewing what actually is a forward interest rate. Now, the simplest way to understand is, and this is really, really simple, okay? So if you have a 1 year interest rate, so 0, 1 year, and 2 years. So if the 1 year interest rate is X, per annum, of course, per annum, and then the 2 year interest rate was Y% per annum, it would enable you always to calculate what is the 1 year rate in 1 year's time, for the very simple reason that 1 plus Y squared should be equal to 1 plus X times 1 plus Z. So you know what that is. You know what this is. It's one equation, one unknown. Everyone is okay with that. That's the mechanism of forward rates. And it doesn't have to be 1 year into 1 year, like I said. It can even be, 1 year, and then there is another interest rate, 1 year and 1 day. I know it's a bit extreme, but we really do that when we are modeling. We don't really care whether it's 1 year into 1 year or 1 year into 1 day. So the gap is now just 1 day. So because you have the so this is X, this is the 1 year rate, and if the whole thing, so I still call it Y, is 1 year and 1 day, then the Z now is just the 1 day interest rate in 1 year's time. Now you might think this is kind of silly. It isn't, because you can really take it to extreme, and then you can also do, let's say you have another one. So this is now this is a 3-month interest rate, 3-month interest rate, and this is 3 months and 1 day. So now you have the 1 day interest rate in 3 months' time, the forward interest rate. Are you with me? Yeah? Okay. So, and then you can even take it to extreme. How about you have a 3-month interest rate, and then you have an interest rate for 3 months and 1 hour? Okay. Just the concept. Okay. And then you make it shorter and shorter and shorter until you come up with this idea, what's called the instantaneous forward rate. Instantaneous forward rate. So if you know the 3-month interest rate, and you know the interest rate for 3 months and 1 second. Okay, I know it's silly, but you get the point. Right? So hello, then you can figure out what is the 1 second interest rate in 3 months' time. Okay, it's all in the concept. So now, so that's forward rate, and I find interest rates really fascinating because it is far more challenging to model. And as you know, so I just told you that if you have a 1 year interest rate, and then you have a 2 year interest rate, then if this is the 1 year, and this is the 2 year, and then you can work out the 1 year into 1 year. Well, you can actually flip this around. You can say, well, look, if I know the 1 year interest rate, if I do, and then I also have the 1 year interest rate in 1 year, that's the Z, then I can kind of flip back and forth. So now I know the 2-year spot rate. Now, of course, you don't know this, but you certainly do know this, and you certainly do know this, and well, you kind of do know is that is the implied. The proper word is the implied forward rate. And that should be a number that you can easily determine under all circumstances. Are you okay, Maria? I will share these notes with you. You can take pictures if you want, but I'm going to make them available to everyone. Especially today, as I wrote out some derivation in longhand. Is everyone is okay with that? Yeah. So what you can end up doing is, so you have a spot curve. It doesn't matter how long it is. It can even be 30 years. You can actually break it up into little chunks. So 1 year, and then the forward rate, 1 year into 1 year, the 1 year rate in 2 years' time. It's like a train, you know, with all these carriages, all linked together, and you can study the individual carriages, or you can hook them all together in one big long train. And the no arbitrage models is based on precisely that very elegant insight. Now, if I can just go back a bit. So I said to you that these are the, this is the equilibrium class of models. So when you are using this approach, what you're doing is you're asking yourself, okay, if this is a spot rate right now, and it doesn't matter whether I'm modeling, you know, the 1 day interest rate or the 1 hour interest rate. So you are asking yourself, how is this likely to change over time from now until, you know, 2049 or whatever. So when you can figure out how it will change over time, then of course you can then you can try and derive some kind of yield curve from that. Okay. Now, I guess they don't do that anymore. If you remember, you know, even when we were, and I go back now to the maybe the preterm in August last year, and I said to you guys that when you have been in finance for long enough, you start to, and probably you guys already are, you start to get a feel for the personalities of the different asset classes, equity and commodities and foreign exchange and interest rates. And my point here is, I simply don't think you can model an interest rate in a random fashion the way you are modeling a stock price, which is kind of what they are doing here. Now, the Varsi check is a little bit better because since there is a minus sign in front of the R, and then the CIR, the Cox Ingersoll Ross, so at least there is a mean reversion element, which is to say, as the interest rate goes up, there is a tendency then for the increment to go in the other direction. So it's kind of constantly pulling you back in some kind of mean reversion average. So at least it has that feature. But otherwise, I don't know if you can model interest rates the way you model the stock market or the movement of a stock. Actually, you know, one of the I tell you, one of the debates for a long time regarding these models, including the no arbitrage models, was that they are unable to cater for negative interest rates. In other words, you could get into situations where the interest rate became a negative value. And for academics at the time, and I'm talking like, 10 years or maybe more, for academics at the time, they thought that this was a major limitation, because they thought that interest rates should never be negative. And you know what? They did become negative. So that was, in the end, it became quite a revelation or revealing issue. Now, so what are they doing with the no arbitrage models? So what they do, as I said, is they don't try to guess where the short rate will go from one moment to the next. Can you imagine trying to do that all the way up to 30 years, regardless of what model you have? But what they do instead is they will take a yield curve and they will look at, okay, let's have a look at what the actual forward rates are, one after another. It doesn't matter you're looking at the 1 day rate in 1 day's time, 1 day rate in 2 days' time, whatever. So they take a look at all these forward rates, and these are derived from the spot curve, pretty much like how I described to you just now. Okay, so they would derive all these forward rates, and then they model how these will change individually, one by one. And so they use some kind of functional form to characterize. But one thing you can be sure of is, because they are using these as an input, it will be completely consistent with the yield curve, with the market yield curve. Okay, so at least that problem is overcome. And like I said, this was pioneered by a pair of academics, Ho and Lee, and you can read their paper online if you want to. Now, let me just go back a bit, and I want to just draw your attention to, somebody was asking, I think it was lecture 3, where Keith touched upon the Cox-Ingersoll-Ross interest rate model. And he gave you guys a little challenge. Oh, here we are. Okay, so on page 9, a CIR short rate process is of the form, this one, and find the expectation and the variance. Now, I think he covered that to some degree in the class. So what I want to do actually is to take that one step further. So I won't go through this one, but I'll show you something similar. Hold on. And instead of doing this, I will take another example. I'm going to take the Vasicek example, and the only difference between the two is that in the random term there is no square root of r, but otherwise it's the same. What I would do is to try and share with you the Vasicek. So I'm going to change this question and discuss the Vasicek short rate process. So like I said, what this is a speculation if I may use that word, or this is an assumption of how short rates behave over time. So you can think of this as a stock price, although you really shouldn't. Okay, it's a random variable that will change over time. So given that if this is the stochastic process, then what is the mean and what is the sigma square? Okay, now I've actually done the work here already because I don't want to waste the time just scribbling, but I will go through it with you. So this is the stochastic process according to Vasicek, and what you do is if you take expectation of both sides, then d of ER is equal to A minus B times ER dt, because the expectation of the second term should be 0. The expectation on the sigma is 0. And then what you do is you take the dt to the other side. Okay, I'm just rearranging it. And then now the integrating factor that you use actually is this one. And what I guess the key here is the recognition that this thing here, or this thing multiplied by e to the bt, is actually the differential of that. So if you integrate this one, so the dash here is the derivative. Okay, so e to the bt times er if you differentiate that, okay, you get this one, which actually is, I haven't changed the right hand side. Okay, so it's equal to a e to the bt. So that means this would be the integral. So you are integrating both sides. So you integrate the left hand side, then the derivative disappears, and then the right hand side you're going to integrate that, and then you simply get a over b times e to the bt plus a constant. Okay, and what you do next is you say, this is just simple, calculus. You say that at the very beginning, when time is equal to 0, at r equals to 0, r naught should be equal to just a over b plus c, okay, because the exponential term will disappear. Okay. So you get the constant c is equal to r naught minus ab, and you plug that back because you already have this formula here, and then you plug the c back, and the expectation is therefore a over b plus e to the minus bt, and then you just substitute the c with what you discovered earlier. Okay, so that's what you do. I guess the key, so this is an example of, when someone gives you a standard stochastic process, and then they ask you, can you please solve for the expectation and the sigma square? This is how you would do it. And it depends on you recognizing, the appropriate integrating factor to use. Now, as for the variance, which I'm doing here. There is a step missing. Now, what you need to do when you want to determine what dr square is that it is actually equals to 2r dt plus sigma. Now, this is just from Ito's formula, okay, or Ito's lemma. So I skipped a step here. And then what you do is you just multiply, this is not z, this is 2. Okay, you just multiply the r no, hold on. No, I mean 2r dr, sorry. Okay, so you just multiply, so this dr term is the original formulation up here. So you're always going to need that when you want to solve for the variance. And then if you multiply that functional form into 2r, you get this expression here, number 1. And then if you take expectation of both sides, the this one will conveniently disappear because the sigma is supposed to be, the expectation of that is 0. Okay? So you're left with this term, and this one, and this one. And what you do is you take the dt to the other side. Okay, this is all I've done is you take the dt here, dt here, dt here, and then you move the 2b times e to the r square also to the other. This is this one. So you take this term to the left hand side. So this is your integrating factor. And so you need to know that the derivative of this is equal to that, which is actually the left hand side of on top. Okay, so that means this on its own would be the integral of whatever you had on the right hand side. And if you integrate that, this is actually the result. Okay, I'm sorry it's a little bit messy. I didn't have time to type it up, so I just did it longhand. And then you substitute in what happens, the boundary condition when t is equal to 0. You get this formula here, and you try to figure out what happens at the start, okay? And this is the constant that you get. Now, the variance of r is equal to the expectation of the square minus the square of the expectation. So you plug the whole thing in. The first part came from above, okay? Now, if this is a bit hard for you to digest, like I said, you can take pictures if you want, but I will share, in fact, I better share this with you later today. I'm going to digitize all of these notes, all of them, including this page, and then I will put that on Blackboard, okay? And then you just plug in the values, and once you simplify them, and I have checked 2 times that this is correct, okay? The result is sigma square over 2b times 1 minus e to the power of minus 2 bt. Okay, this just comes from simplifying and collecting all the terms. Okay, so that is, I guess, a typical example of, you know, somebody giving you a stochastic process, and then you go away and say, oh, all right, well, then let me try and figure out what is the expectation, and then you have to use the right integrating factor, and then you integrate it, and then you find a constant, you plug it back in, and the same for the variance. But for the variance, I think this is an important step, which I didn't write down, okay, is this came from the Ito's lemma. Okay. It'll take me quite a while to type this up, I think. Now let me get on to another. I think this is something you should know. Very basic demonstration of how you take a random process and then try and figure out random stochastic process and then figure out the expectation and also the variance. Now, what I want to do is actually share with you a little bit regarding this topic of convexity adjustment. I know I have asked you before, but allow me to ask again. So no one discussed this with you anywhere else? Did you talk about this in derivatives market? No. Did you talk about euro-dollar futures? Did you talk about there's a dimension of, I don't know what to call it. It can sometimes be a bit unfair to one side of the market relative to the other. Did you guys discuss that? No. Okay. No, not carry trade. Carry trade wouldn't be unfair because you are taking risks. Okay. Now this is actually quite interesting, and it is only one example of convexity adjustments, but you see that a lot in the interest rate world. Now, first of all, let me so let's go through this together. So I'm saying to you that in the derivative market, and especially in interest rates, in fixed income, sometimes it may be that you think your payoff is linear, but as it turns out, there is something else hidden that makes it non-linear. Now, in the case of interest rate forwards versus interest rate futures, for example, you all know the difference between a forward contract and a futures contract. Yeah. Very good. So the futures exchange, the futures contract is something that you and I can trade. Although for euro-dollar futures, the notional size for one contract actually is $1 million US. So I doubt if I have the need to trade to manage $1 million US of interest rate risk. Well, not yet anyway. If a big company like BlackRock wants to manage the interest rate risk, what they can do actually is pick up the phone and call JP Morgan, and the two of them can trade in private an interest rate forward contract. Okay? And nobody needs to know about it, and at least technically, after they do the trade, nothing else needs to happen, at least in theory. So if I am BlackRock and you are JP Morgan, I pick up the phone and I want to trade an interest rate contract with you. So we say, okay, whatever is the rate, okay, is done for $50 million. Nothing else happens until 3-6 months later. Now that is not the case for interest rate futures. Apart from the fact that it is traded in the futures exchange, as Li Wei was saying, the key difference is that with interest rate futures, you need to post margins. So when you have losses, you need to get money, or they will take money from your pocket. When I say your pocket, I mean your account. Okay, they will take money from your account, which probably was earning some interest, but they really will take money from they really do. Okay, they take money. So overnight, you see money leaving your account, and it goes into some kind of margin account. So when you are losing, you need, or if you don't have money, you need to borrow money to put in the margin account. And when you are winning, they put money in your account. They do, okay? And you can earn interest on that. Now, why do I say this is the key difference? Let me just introduce you to, and this would be of interest to you if you want to get into interest rate modeling or interest rate trading. First of all, the market convention of euro-dollar futures is a little bit strange. I don't know if I can, hopefully can. So euro-dollar futures contract spec. Okay, so here is what it looks like on the CME, and first of all, the notional size is $1 million, and now notice where it says 100 minus R. I'll see if I can show you some prices, and then I'm going to explain what the problem is, and I'm going to explain how they solve that problem by way of convexity adjustment. Can I get some prices? Okay, quotes. So here we have, so market's already closed, but never mind. Now, take a look at the first one. So June 2019, and the last price, or the closing price, is 97.475. Do you know what that means? 97475. So I've just drawn your attention to a date and a number, 97475. What is this? This is from last time. 97475. Now, I'll tell you what that is. So today is 26th of May, 2019. What this is this is a forward rate. This is a contract for settlement probably somewhere around 20th of June. It's normally the third Friday of the month. Well, I can tell you exactly when that is. What's the third Friday of next month? '21st. Okay, so for the 21st of June, the market thinks the 3-month forward rate for this period should be, that's when the 100 minus R is relevant. Now this is R. So what's 100 minus this? Is around 2.525, isn't it? Percent per annum. Yeah? So the market thinks that the 3-month interest rate, 1 month from now, is 2.525. Now, it is entirely your freedom. If you want to disagree with it, you may think it should be higher, you may think it should be lower. That is entirely your business. But you can see that here there are a whole load of quotations, June, July, August, September, October, all the way out to fairly long dates. So immediately you are probably thinking, wow, these actually can be by forward rates, and they can. So already the market is trying to help you. Going all the way on, these are not that liquid. Okay, but the contracts are there. But let's just take a look at the first one. Okay. Now this is the futures market. So the futures market is saying that the 3-month, in fact, it's the 3-month LIBOR rate. Okay, so the LIBOR, so the euro dollar futures market actually is a market for hedging LIBOR interest rates, and it's absolutely huge. So this is the value. Now, like I said, the quotation is 100 minus, is really strange. So if you think that in 3 months' time, if you think that the interest rate should be higher than 2.52, if you think so, okay, so that means the value, the end value would be lower than so the futures value for euro dollars will be less than 97.475. Okay, now in which case what you need to do is, thank you, someone said you go short. You do, okay? You go short the contract. This is just market convention. I'm not telling you any math. I'm just telling you how it works, okay? You will go around, you tell the whole world, oh, I'm short the euro dollar futures contract. Okay? That means you expect that 90-something number to go down. That means you expect interest rates to go higher than what the forward rate is showing now. Is that okay with everyone? It's a little bit like trading bonds. So if you think yields are going to go up, that means if you think bond prices are going to go down, you want to go short bonds. This is kind of like trading a bond. Okay. Now the opposite is also true. So if you think that the interest rate is going to go down, then the end value of this will be bigger than this. So that means you go long, correct? Now this is just the language, but I need to define for you the language first before I explain what the problem is. Okay, is everyone okay with that? Yeah? Um, and what would happen is, well, while we're on the subject, okay, so if it turns out that the forward rate in June, okay, let's say it dropped to 1.5, let's just say it does, then the settlement value would be 100 minus that, which is 98.5. And if you trade $1 million, then if you are long, you will actually make that amount of money, but you have to divide it by 4, okay, because it's quarterly. Okay, so that's the market convention. Now, but this is not what I want to talk about. What I want to talk about is this. So here's the problem. Now, if you are short the futures contract, so that means you expect the futures contract value to go down. So you can also say you are long rates. Some traders talk like that. So they will tell them, the boss will ask them, are you long rates or short rates? And they say, okay, I'm long rates. And the boss will ask them, are you short the euro dollar futures or long the euro dollar? That takes longer. Euro dollar futures. It's faster than you say rates. Okay? But the two are kind of the same. And what I'm saying is, now, just read carefully what happens when interest rates go down. Okay? When interest rates go up. So let's say you've done a trade, you are a trader, and you did this. So you are short the futures, and you are long the rates, and after you do the trade, rates start to rise, which is exactly your view. So you're going to make some profit on the mark-to-market. Now that means there will be money pouring into your futures account because you're making money. I said to you that when you have a profitable futures trade, the futures exchange will take money from someone who is losing and put it into the account of someone who is winning. So you will get money in your account and you're going to earn interest on it. Well, guess what? You're going to earn interest and interest rates have gone up. So that means you're going to make more profit on a profit. Okay? That is when you are short the euro dollar futures and interest rate rise, you make profit to start with because of the mark-to-market. When money comes into your account, that money is going to attract even more money, more profit, because the rates are rising. So that's what I mean by more profit on profit. You know what I'm saying? Yeah? Now, take a look at this line here. So jump to this one. So the same position. So it's the same trader, and I'm talking about the same trade, but now your view is wrong because you were betting that interest rates will go up. That's your bet. You were betting that the euro dollar futures, that 90 something number, you were betting that it will go down. You're betting that rates will go up, but you're wrong. So rates are falling and you have a mark-to-market loss. So now you need to borrow money from somewhere in order to put it into the winner's account. So this one should say fall, not rise. Okay, now the end result is, so now you need to borrow money to pay up your margin account. But you know what? Because interest rates are falling, your borrowing cost is going to be less. Maybe when you did the trade, the forward rate or the entire market, interest rate market was here. And after you do the trade, interest rates started going down, so now it's here. Okay, you get it wrong. You've got it wrong, but you're going to need to borrow money to pay for the margining. But your borrowing cost will be less because interest rates themselves have dropped. So what that means is when you are short the euro-dollar futures, when you're long rates, you have more profit on profit and less loss on loss. Now that must mean that the guy on the other side is having exactly the opposite. That's really good, isn't it? When you make money, so you have money in your pocket, and you know you can earn more interest on it. When you have a loss, too bad, but your borrowing costs will drop. So more profit on profit, less loss on loss. Now, ladies and gentlemen, this is kind of, a summary of the convexity adjustment formula, which is when you are dealing with a product, like an interest rate based product, so that underlying itself will generate you a profit or loss. But in the futures market, because you need to either borrow or you receive deposits, there is a secondary effect to it. And in this case, it's always going to be one-sided. It's always going to be in favor of the short party. The long party is, so if you're long the futures, so you expect that 90-something number to go up. Or you can say you are short rates, so you expect rates to go down, okay? But you get it wrong, rates go up. So you have a mark-to-market loss. Guess what? You need to borrow money, and you need to borrow more because interest rates have now gone up. So you have more loss on loss. And the other side, you have less profit on profit. You know what I'm saying? Yeah? Hmm? Yeah. That's a good point. So it looks like it's permanently unfair for the trader on the long side. So you must be asking, well, who's going to trade this? So here, so the two parties do recognize there is a potential profit and loss asymmetry. Why? Well, I just explained to you why. Okay. And it has to do with the daily mark-to-market. Now, the mark-to-market is a feature, well, not just the mark-to-market, but posting margins back and forth is a feature of the futures market, which you don't see in the forward market. So therefore, it leads to a recognition between the two parties. So I'm saying to you that if you are long futures, if you are betting on rates to drop, you are always at a disadvantage. And long futures means, so the futures contract is now 97 point, I've forgotten what it was, 475, whatever, okay? So that means, so you're long the futures, think of this as kind of like a bond. So you are buying this, hoping that this number will go up by settlement. and you are permanently disadvantaged. It doesn't matter which way the market turns. The way people try to compensate for that is to say, all right, if I'm on the long side, I don't want to pay this. I don't. I want to pay less or more. Less? More? Who wants to pay more? We want to pay less. I want to pay less. I don't know how much. I just know that this is not the right price. And what people do is they actually look at the forward market. So let's say the forward market is trading, let's just say it is, okay, trading at 97.55. This is the forward market. So people in the futures market will say, hey, look, this is where the forward market is trading. You want me to buy? Sure, but I want a discount. I'm not going to pay this. I am definitely going to pay less. And people on the short side will say, oh, all right, yeah, but they also recognize there is something which is inherently unfair between the two sides. So you want the other party to play with you, and then you have to be fair. Now this, ladies and gentlemen, this gap here, which is what, 7.5 cents, I'm just making that up. It's what's known as convexity adjustment. In other words, if the forward is X, the futures price should always be less than X after the convexity adjustment. And that is why here, if this is the forward price, okay, the futures price is, so forward is equal to futures minus convexity adjustment. Sorry, here I'm using the interest rate. Yeah, the rate, okay? But here I was using the prices. I'm sorry if that is confusing you, okay? So if you talk in price terms, then the forward price is always going to be higher than the futures price that I want to pay. But if it's rates, if you are talking interest rates, then it is the opposite. If the forward price was 97.55 and we are trading the futures and you want me to go long, I want to pay less. So let's say 97.45. But if you translate it into rate terms, the rate of this is 2.45 for the forward, whereas this one is 2.55. So the futures rate is equal to the forward rate plus a convexity adjustment. This is the problem with interest rates. You're often switching between rates and price. So it gets a bit confusing. Is everyone okay with that? Now, this situation happens very often in a fixed income world. Like I said, when does it happen? It happens when you are trading some kind of forward interest rate underlying, where the P&L on a daily basis is itself affected by interest rate movements. Are you with me? Another example, by the way, is CMS, which we talked about last time. But that's not really in the course. But if you are interested, actually, even in the Hull book, there's a derivation of CMS convexity adjustment. Now the thing is, I just told you, okay, this is the convexity adjustment. Oh yeah, that's interesting. What should it be? I just said it was 10 cents. Why 10? Why not 12? I haven't told you how you can figure this out. Okay? But actually there is a way. There is a way. I mean we know that you should add to it, fine. But how much do you add? Now here is one suggestion. So I said the forward rate is the futures rate. Okay? The forward rate should be the futures rate minus a convexity adjustment and rate. Okay. One suggestion that has been made is a half times sigma squared T1, T2. I'll tell you what T1, T2 is. So if you are trading, if now T is 0, and you are trading a forward rate between T1 and T2, so this is T1, this is T2. Okay, now this is what someone came up with, and you're wondering, oh, that's interesting. Yeah, where does that come from? Now, I don't like just giving you formulas and saying, okay, that's the adjustment. So I'm going to try and show you where this came from. Now, just by definition, now I've defined for you the forward rate. Like I said, forward rates are like trains with carriages. So if you know this is 0 and 1 year and 2 year, so if you know the 2-year interest rate and you know the 1-year interest rate, you can derive the 1 year into 1 year. This is just the continuous compound inversion. This is a standard formula for forward rates. Looking at it from time t, the forward rate between T1 and T2, so that would be 1 here. Okay. Now, if you use Ito's lemma, a small increment of that function, that's why Ito's lemma is so useful. It crops up everywhere. This is the standard Ito formulation of that forward rate. And what we want to see is this result. Now, how do you get that? What you can do is, so this is basically the stochastic process on a small change of that forward rate. And if you take expectation of this over time by simply integrating this over dt, okay, I think I'll try and do that on a, see if I can do that here, okay. Now I lose that. Hold on. Let me get that formula back. Here we go. So I'm going to copy and paste this. I think I can do that, can I not? I'm going to copy and paste this here. Yes. Isn't that nice? Now, so I'm going to try and take expectation on this thing by integrating both sides over dt. Okay, so the expectation of this thing. Now, first of all, this term first up, this one will disappear. And I'm left with so I want to integrate sigma square. I'm going to try and take out some of the terms in the process. And I'm going to multiply out the T2 minus T all square. So that is T2. Now don't worry if you don't follow me. First of all, this is all on video. And then you're going to get these notes anyway. Okay. So T2 little t. I'm just simply multiplying out this term here. Okay. Plus T square minus, so the second term is T1 all squared minus 2 T1 little t plus T square all divided by T2 minus T1. This just came from here, okay? And I want to integrate that between 0 and T1, because in the end, what I'm doing is, so the time now is 0, I want to determine how this forward rate increment can change, how this bit here can change from the time here to here. Okay, so that's why I'm integrating this function over dt from 0 to T1, and that gives me, so the sigma square doesn't change, but I get T2 square minus, so here from here, T1 square minus 2T2T plus 2T1T, all divided by T2 minus T1. Now the T square, this one here and this one here, they will cancel out because there's a minus sign here, okay? Now this is surprisingly elegant, as you will see in a minute. So this is T2 squared minus T1 squared minus, I'm going to take the 2T out, 2T, then is T2 minus T1, all divided by T2 minus T1 dt. And this is equal to sigma square. So because T2 square minus T1 square is equal to T2 minus T1 times T2 plus T1, so I can actually split that up into T2 minus T1 in brackets, T2 plus T1. You can kind of see where this is going. Minus 2T. This minus 2T multiplied by this term is actually the same as this one here, okay? All divided by T2 minus T1 dt. And in fact, it will simplify to so this one and this one, they actually cancel each other out. And you are left with T2 plus T1 minus 2t. Now, like I said, you are integrating between 0 and t1. So when you integrate this, it is equal to sigma square over 2 t2 plus t1 times t. I'm now doing the integration, minus t square, and you have to put in the values between 0 and t1. And when you put in 0, actually this term disappears and this term disappears, so there's nothing to do with the 0. So you just put in t1, substitute t1 for the t, so that means it's sigma square t2 plus t1 times t1 minus t1 square. I'm simply taking this little t1, big T1 I should say, and putting it into the little t here, okay? And when you do this, you are left with sigma square, so there should be a bracket out here, okay? Sigma square t1 t2 plus t1 all squared minus t1 all squared, which is what? Which is a half sigma t1 t2. Is that the result? Well, I'm so relieved. I thought I might get something different. Are you with me there? Isn't that so elegant? Don't you think math is wonderful? You don't need to talk a lot. Professor Yang disagrees. You don't need to talk a lot. Just do it. And then it reduces to a mighty simplicity. So notice one thing of interest is all I did was I took the standard definition of a forward rate, this one, okay? I took a standard definition, and then there's no argument about that. And then I simply say to you that if I can take expectation on the change of the differential, and then when I integrate that, so that in the end I'm trying to determine, okay, how does it change over time, and I want to be compensated for that potential change. And then this is the result, okay? So this is why people suggest that the convexity adjustment ought to be a half sigma T1, T2, okay? So what have we done today? As a summary, we had a recap on the classic, I'll use that word politely, okay? The classic interest rate modeling processes, and there are 3 that are in front of you. And in fact, these are related to lecture number 3, where at one point you are asked to derive the expectation and the sigma square for the Cox-Ingersoll-Ross short rate process. I think Keith already went through that, so I thought I'd do something different. I've done the same thing, except that I'm doing it with the Vasicek. And as I said, you will find that in the notes in tutorial 9. It's actually up here, and I hope you can read my writing, but it will all be here. It will be available to all of you. So that's the first thing we did. The second thing we did was we had a quick review of just what the hell is convexity adjustment? Why does it come up? Well, it comes up because quite often when you are trading interest rate underlyings, not only are your profits influenced by the market, but you can get profit on profit, or you reduce your loss on loss. it's always one side better than the other. It's like Herschel wing tail islands, okay? One ocean islands. So you need to make some adjustments so it is fair for both parties. And that adjustment, if you believe in the methodology that I use, which is to take the stochastic process for, this is what they call the instantaneous forward rate that I was trying to tell you. Instantaneous. It's a tiny, tiny, tiny forward rate. From T to 1, I should say. It's a tiny, tiny bit. And how does it change? So when you integrate that over time, you get a kind of average expectation. The result is actually this. And how do we get that? By doing what I just did down here. You take the stochastic process for the forward rate, and then you try to integrate that over time. I couldn't find that in a textbook, so I did this myself. All right, I hope that is of interest to you. I do feel this is something I'm passionate about, and it fascinates me. So I just share that with you for your interest and for your professional or technical development. You don't have to know it if you don't want to, but this part I think you certainly should know. Okay, the first part of today's tutorial. So try to get a handle on that, and make sure you get comfortable with what I'm doing. All right, and if I made a mistake, tell me. Okay. All right, I'm going to let you guys go. And if you haven't signed your attendance, please feel free to do so. We will meet here again. For those of you who are a little bit late, just want to let you know, we'll meet here one more time next week, and then we will meet here on the 4th of June in the evening, and I will send an invitation to all of you guys. Okay. So if you need to sign your attendance, here it is. Otherwise, have a very good weekend.